What Ethereum serves for is a global settlement layer to the economy of the world.
Why does anyone want exposure to ETH?
Ether is a yield-generating asset, like a digital version of oil. And due to its proof of stake, we're able to intrinsically generate yield from Ether. We're going to see all of the major financial institutions following suit as Ethereum continues to cement itself as this global settlement layer of humanity. Our operating vehicle model, unlike the ETFs, enables public market investors to have access to the full productivity of Ether yield.
One of the big things about you, Andrew, is I think you put in about 650 million of your own supply of ETH, which gives you a ton of cred.
For me, with my assets, that was the only way I could get comfortable with this model.
What does Ether Machine look like a year from now?
We aspire to be number one. We're maniacally focused on generating Ether concentration per share at the most minimal risk.
You've been in this business for over 10 years. You still seem very excited about this, and I don't see any gray hair.
I don't think I have physical gray hair, but know that I have spiritual gray hair. I am still excited today as I was a decade ago. In the end, what I'm doing is going to be one of multiple pillars that can give public market investors exposure to the asset class, but also be a microphone to explain how Ethereum works to society.
Hey, I know investing in crypto is scary. It takes a real leap of faith because there are so many scams, rug pulls, and bad actors out there. It's a dangerous business, which is why 95% of people lose all their money. Well, that's why I created the London Real Investment Club, so you can access the hottest deals on the planet and use the crypto bull market to create the generational wealth that you deserve. Join my team of over 100 people from around the world that are making millions of dollars behind the scenes investing in blockchain, AI, Web3 games, DeFi, Bitcoin, and more. Don't miss out. Click the link below to book a call with one of my team now. But hurry, this bull market will end soon.
I know investing in crypto can be scary. That's why you gotta join the investment club. Pull the trigger. Let's do this.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is...
This is London Real. I am Brian Rose. My guest today is Andrew Keys, the entrepreneur, Ethereum pioneer, and CEO of the Ether Machine. You began your career in traditional finance before joining ConsenSys in 2014, where you helped scale Ethereum to global adoption. Later, you co-founded DARMA Capital, bringing institutional discipline to digital assets. Today, as CEO of the Ether Machine, you're leading a $2.5 billion Ethereum treasury that accumulates, stakes, and actively manages ETH as the reserve asset of the internet. With a planned Nasdaq listing, you aim to create the world's first pure-play, dedicated Ethereum treasury company designed from the ground up for ETH accumulation and institutional-grade yield generation. Andrew, welcome to London Real.
Thanks for having me, Brian.
Look, it's great to have you here, and I just want to jump right into it. You know, for people that don't fully understand what you're doing, can you just break it down and explain what is an Ethereum treasury company? Why do we need them? And why are we seeing so many launching in the last, 60 days? It's like you got Tom Lee's BitMine, you got your old buddy Joe Lubin, and what he's doing, obviously, over at SharpLink. Why now, and why do we need these things?
So we'll start with why now. I think there have been a confluence of factors that have created this Cambrian explosion. First and foremost, in December of 2024, so approximately 8 months ago, there was an update through the Financial Accounting Standards Board, the FASB, defining that digital assets like Ether could be marked to market within a public company. So basically, what that did was basically greenlight the ability to hold these assets on balance sheet and to be properly accounted for. It was kind of another step, albeit a boring one in an accounting nuance. And we think that was kind of the light of the match of why this started to make sense. Another reason is that I learned personally that ETFs were an inferior way to express one's interest specifically in Ether. And the reason of that is a bit of a technical nuance. And that's something to do with what's called the withdrawal queue within Ethereum. Right now, the ETFs in America do not enable staking. We believe that that's going to happen soon, but in Europe or in Canada as a proxy, staking is enabled. And what we've seen is they're staking at what I would call 50% capacity, meaning if you had €1 billion in a staking, in an Ethereum ETP in Europe, they're only staking €500 million, and they're only earning the vanilla floor, meaning that they're only earning the table stakes staking yield, which right now is about 3%. So on the $1 billion, 500 million is being staked, and that's earning 3% to really generate a 1.5% yield on the total amount of capital. And the reason this occurs is because in Ethereum, if you were to unstake your assets today, you should get it back in a couple days. But if, God forbid, there was a bad hack or some type of black swan event where lots of stakers wanted to unstake at the same time, the withdrawal queue to unstake could grow from a couple of days to months or even a year. And that doesn't jive well with the ETF requirements to have 24-hour redemptions. So if you were to redeem your stock, the ETFs have to be able to sell that out and give you your fiat currency within 24 hours. And there's no way, because this is denominated in Ether, it's not even denominated in dollars. There's not a way to basically underwrite that risk. So the best thing that the ETPs, the ETFs can do is just stake less. And so with that said, I had previously been building a commodity pool operator and commodity trading advisor registered with the CFTC because Ether is a commodity that staked institutional size billions of dollars of Ether already since the inception of proof of stake. And when I understood that I could basically have a public vehicle that, unlike the ETFs, could stake at full capacity, something that we were already doing. And then furthermore, we could add additional yield generation through concepts like restaking and participation in DeFi. I thought of this like a perpetual bond. And Ethereum should be considered, let's call it, from the yield generation dynamics, as a perpetual bond, where it is able to generate this yield. And I compared it to what one would be able to achieve through the ETF. If you double the yield, you essentially double the price of that bond. And basically what we saw is the ETFs really are only able to do 50% capacity of the first third of yield generation activities, which is vanilla staking. And they're not able to do restaking and participation of DeFi. So we're able to do all three of those buckets. Plus, we're able to add what I would just call the capital markets financial instruments, such as creating convertible bonds and or preferred shares to further add to our North Star, which is our Ether concentration per share.
Okay, and you can also add on top of that some of the exotic yield generating instruments like the restaking and things like that.
Exactly.
Okay, and so what looked like a problem for the ETF, you're taking advantage of that and creating a brand new product that can solve that issue.
Exactly.
And that issue isn't going to get solved anytime soon. I mean, when you talk about that whole issue of unstaking and that unknown time delay, does that mean it will be difficult to get a staking-based ETF for ETH?
So I think that a staking-based ETF will occur, but I don't think that they're going to be able to stake at full capacity. If they basically, I think that they have kind of two roadmaps to do, or paths, if you will. One is they could stake, and they're going to stake at, maybe it's 50%, 60% capacity, or they could stake potentially using what's called a liquid staking token, but that introduces other vectors. Other attack vectors. You're talking about introducing smart contract risk, and you're now introducing vectors of the bid-ask spread between a liquid staking token and just pure vanilla Ether, which is basically adding another transaction. What I think is a much better mousetrap is having an operating company that has a business to secure Ethereum, and to generate yield, and to avail ourselves to the full suite of Ethereum's productivity, which is staking, restaking, and participation in DeFi. Plus, on the traditional financial side of the equation, the ability to sell convertible bonds and/or preferred shares to volatility-seeking or credit-seeking investors. And using the proceeds of that to add Ether to our balance sheet for shareholders that want Ether concentration to increase per share.
Okay, and I definitely want to get into that. You could argue that Michael Saylor kind of wrote the book on that for Bitcoin.
For sure.
And I want to get to that. But if we zoomed out really high up and we took a look at 30,000 feet, if an institution or a person, I guess, wants exposure to Ethereum, they kind of have maybe three-ish choices. They can buy the Ethereum somehow and find a wallet to hold it in and keep it safe, which could be challenging. They can buy the ETF now and not get any yield component, but they can have the exposure. Or they could go and buy some Ether machine or an Ethereum Treasury company. Are those kind of the three options for any type of size? And could you walk people through the problems with those? I think you kind of talked about the ETF there. Sure. And maybe how a lot of institutions, Saylor was just on CNBC 2 days ago and he said 98% of the institutions in the world cannot hold crypto. And so that's not even an option, but they all have accounts on the New York Stock Exchange.
Exactly. So first and foremost, one can go acquire Ether spot and let's say use a retail exchange. They now are responsible for the public-private key pair, hacking, et cetera, and/or hiding the ledger, under their bed, and keeping the 12 worded seed phrase. And then if they were to use any one of these retail exchanges, back of the napkin, they charge 25% of the staking yield that they generate. So that's the first example. Secondarily, the ETFs, as we just discussed, is like owning a stock that has a dividend, but availing yourself to half the dividend that you're entitled to, or in case of the U.S. right now, 0% of the dividend, because right now in the ETFs they are not enabling staking yield, and then furthermore, it's really availing yourselves because ETFs are somewhat rigid in their exposure to kind of what you can do with the underlying asset. They haven't been created, specifically for a productive asset, what I would call kind of like this triple point asset of Ether that can derive value multiple ways. Where you can have it from staking, from restaking, and participation in DeFi. You're really only able to do that first third. And then these operating vehicles done properly we believe is the best way to do it. And then there are nuances within the operating vehicles that we can touch on and kind of why we chose to go in our route, which was creating a de novo entity with a SPAC versus doing a reverse takeover of a shell. But I'll digress. But basically, I think our operating vehicle model enables public market investors to have access to the full yield, the full productivity of Ether yield, staking, restaking, and DeFi, and the full product suite that an equity operating business can enable, such as ATM equity issuance, preferred shares, and convertible bonds.
Excellent. Okay, and I want to get into that. Before we do, why does anyone want exposure to ETH? We clearly have seen the use case, and Saylor kind of built that up. He's been on our show, I think, back in 21 and back in 22 and 23. And obviously at the time, I think that was the only crypto that was kind of blessed or at least being ignored by the SEC. And so he went full bore, and we saw that. Now, Ethereum, the ETF came a little bit later. It was slow to get started, but now we're seeing more and more interest. The regulations going our way. Stablecoin Act is passed. When I got to Wall Street at the ripe age of 22 years old, I was 1993, and I got sat on the fixed income derivatives desk. And all my friends, when I used to go home in the East Village, said, "Brian, what stock do I buy?" And I said, stocks are for punks. We work in fixed income. And in fixed income, it's all about yield, right? Everything is, what's my overnight rate? What's my 3-month rate? What's my 30 rate? And I grew up in this environment of yield. And so when I used to look at crypto, I would always tell people, you know what? When Wall Street comes, they don't even understand something that doesn't have a yield. And so are we finally seeing them embrace an instrument with an inherent yield and inherent even a yield curve? Is that why ETH is going to be the next big thing, do you think?
So that's one of, I would call, 3 reasons.
Okay.
And we can start there. So first and foremost, Ether is a yield generating asset, versus Bitcoin. Bitcoin I consider unproductive, kind of like gold, and Ether is like a digital version of oil. For every transaction that occurs on the Ethereum blockchain, it requires a micropayment of this fuel. And due to its proof of stake consensus mechanism, we're able to intrinsically generate yield from Ether, unlike Bitcoin that requires real estate, hardware, and electricity consumption. You don't need any of that with this upgraded way to form consensus through proof of stake. So one, you do have this yield generation aspect. Secondarily, to understand this public markets play, one needs to understand kind of who are the stakeholders. And one of the major stakeholders are the shareholders that are buying the underlying stock because they want Ether exposure and the generation of yield, and to have the increase of their Ether concentration per share. So simply put, if you had basically an ETF, you're just getting kind of the Ether exposure, and you can kind of think of that as, one time. But with this, you have a vehicle that is constantly generating additional Ether. So your Ether concentration should be continuously appreciating. So you have kind of Ether exposure plus. And then the other stakeholders in this are the convertible bond and or preferred shared consumers. And we'll simply put, we'll do the convertible bonds to kind of keep it simple. So basically, there are hedge funds and other investors that are actually in the business of acquiring volatility. They don't necessarily care if it's via Bitcoin, whether it's via Ether, or whether it's via data centers, but basically they can acquire volatility in a stock. And what they do is they'll acquire a convertible bond, and they could potentially short the stock or an ETF linked instrument. Like, for example, the BlackRock Ether ETF, and basically live delta neutral but basically earning off of the volatility. And for this, Ether is double the volatility of Bitcoin.
How do you get out of a rat race? How do you create wealth not only for yourself, but also for the generations to come after?
I am absolutely amazed with the quality of companies that we're getting exposure to.
We go on to Zoom calls with the innovators and the folks who are building new applications in metaverse, blockchain, artificial intelligence, decentralized finance.
What's going on, everybody? Thumbs up if you can see me.
We are focusing on early stage investment.
And the quality of people that we're getting exposure to, whether it be Dan Tapiero with 1RT, Jason Ma from Open, Yatsu from Animoca.
It's been a phenomenal experience thus far. It has far exceeded my expectations.
We are focusing on cutting edge technologies.
I view it now as the best investment I've ever made. The upside I view is unlimited.
And as a retail investor, I would never get this exposure anywhere else outside of Investment Club.
See you in the Investment Club.
Plus, it is now, as we previously said, generating yield. So basically, this is just a better asset for this convertible bond flywheel. And if you are kind of a historian of MicroStrategy, what really grew it from single-digit billions of valuation to centabillion was not the ATM equity issuance, but it was the introduction of convertible bonds and preferred shares, where basically we view that as a positive sum game, where we're selling volatility to investors who are looking for volatility, and then we're using those proceeds to buy the underlying asset, in this case, Ether, for the shareholders that want exposure to Ether and the yield that Ether generates. So I would say those are very kind of like technical factors, the yield generation and the volatility. But last, but probably not, and certainly not least, is, what is Ethereum? And why is that important? So basically, I believe Ethereum to be the substrate of the next generation of the internet. And there was a really good artifact that was recently produced by ConsenSys, my alma mater, called the Ethereum Trust Report. And I would recommend that everyone Google ConsenSys Ethereum Trust. And there's a graph that we can put in the show notes that depicts high quality liquid assets. HQLA, which is this term by the Financial Accounting Standards Body. And basically, right now, there's only about $250 billion of high quality liquid assets on blockchains, which is a drop in the bucket, meaning we're in the earliest days of this transition from a natively analog world to a natively digital world where our assets are natively digitized. That said, the $250 billion of assets, 90% of those $250 billion of assets are being settled to Ethereum. And Ethereum is experiencing power law dynamics similar to Google with search, where 90% plus of the stablecoins and the stocks and the bonds and the derivatives are being settled to Ethereum. And then the other 10% are split between, 100 other blockchains. And it just reminds me of 90% of search happens on Google, and 1% happens on Bing, and 1% happens on Ask Jeeves, and 1% happens on Yahoo. And so we're already seeing the fact that liquidity begets liquidity. And Ethereum has this kind of critical lead in being this place where we're seeing most of this commerce settle. And furthermore, the tailwinds that you touched on, Brian, are that we've just seen the Genius Act pass, which gave us clarity around stablecoins. Everyone saw the positive tailwinds to CRCL, Circle, and what we can say about that is the largest beneficiary of Genius was Ethereum, because the majority of the settle coins, the stable coins, settle on Ethereum. In about 2 months, we're going to have the Clarity Act, which is market structure bill, which is kind of the tokenization of stocks, bonds, derivatives. The largest beneficiary of clarity is going to be Ethereum, again, because the majority of these high quality liquid assets are settling on Ethereum. So it's the best substrate, and maybe why that's happening. I would say there are a few reasons why Ethereum has this lead. One, it has what's called client diversity. There are 9 implementations of Ethereum that form consensus every 6 seconds, every time there's a block created. To give you an idea of other blockchains, Solana has 1 implementation. Bitcoin has 1 implementation. So there's 9 implementations of Ethereum, which is important, that if you want to have this global settlement layer for all of Earth's assets that nation states or corporations or people can trustlessly interact through, Ethereum really is the only one that has the ability to have this never ceasing uptime due to that client diversity. And I think that that's extremely important. Another reason is the notion of standards. And kind of, if we're a technological historian, Java became J2EE, Java 2 Enterprise Edition, back in the 90s. And that became the most used software language because there were clean web APIs, that there was a standard, whether you were in Mumbai, Paris, London, San Francisco, there was a standard to use, and there were clean database APIs. And what we're seeing now is Ethereum has done a great job of creating certain standards, token standards. So something like the ERC20 token standard for fungible tokens, or the ERC 725 was an example of one for NFTs. But basically, anyone was able to have this standard token and a standard wallet, and was able to put the token in the wallet, simply put. And so millions of developers could basically coalesce around these standards and build applications that used the same basic ingredients. And that's permeated really well.
Okay. Now, the critics would say that a lot of this activity of the stable coins and the Ethereum chain is happening on these layer 2s like Base and Arbitrum, and they only get settled infrequently onto Ethereum, and the total net fees to Ethereum is like 6 figures. It's very small. What would you say to that? Some called it a ghost chain 6 months ago and said there's just nothing going on there but the rent. Maybe that was a little bit harsh. What do you say to that?
Yeah, so I think that this is an architecture that is created purposefully. And simply put, to kind of zoom out for your listeners, if I were to take Brian to the pub and open the bar tab with a server and hand him or her my credit card and buy us a round of appetizers, a round of drinks, a round of entrees, a round of desserts, pay a tip and close the tab, all of these microtransactions that started from zero and ended at $500 or 500 pounds, those can be batched. And then basically the opening and the closing and the batching of all these transactions can get settled to layer 1. And basically this architecture creates the ability for any application in the world, any company in the world, to customize how they want their layer 2, their environment to work. Some may be optimizing for speed. Some may be optimizing for privacy. Some may be optimizing for 10 people to work together in it. And that's how websites work on the internet, right? I mean, everyone uses HTTP, but Amazon.com, Google.com. And so basically it's reminiscent of how the internet works, where everyone uses HTTP, everyone settles to Ethereum, but there's thousands, millions of different websites. And what we've seen is that Ethereum has optimized for keeping transactions very cost efficient at that layer 1 settlement. And basically it has become the standard choice for companies to create these layer 2 architectures. So we've seen kind of the fast movers, and I think that we're early in this transition period, but Coinbase has created Base, as you referenced. That's their layer 2. Robinhood just created their tokenized version of stocks that settle to Ethereum layer 1. Kraken has created Inc., which is a layer 2 scaling solution, and on and on and on. And now that we have some of these regulatory tailwinds, we're going to see, I think, all of the major financial institutions are going to be kind of following suit. And if we were to kind of use the analogy of ride shares, companies like Uber and Lyft, 5 years ago, it would cost $50 to go from lower Manhattan to upper Manhattan. For the same ride share now, it costs $150. The technology hasn't necessarily changed, but Uber has become ubiquitous. And what we can do is basically have Ethereum as the standard for settlement solutions and settlement layers. And there are ways to basically increase the pricing as it becomes more congested. So there are two burning mechanisms within Ethereum. One's called EIP, Ethereum Improvement Proposal 1559, which burns every layer 1 transaction. So it basically is kind of like a stock buyback, if you will, where basically shares are retired if you're talking to kind of like the traditional financial equities investors. And then there's EIP 4844, which burns Ether for every layer 2 settlement solution. So basically, there are two ways already that this transaction or this transaction occurrence can basically reduce the supply of Ether that can have a positive price occurrence towards the Ethereum network. And there are ways to basically increase the burn per transaction that I believe the foundation will prioritize as Ethereum continues to cement itself as this global settlement layer of humanity.
And I've heard a few people in the space saying that Ethereum is the chosen network because it never had the downtime. It's got the history. And even though Solana might be faster, and maybe it's got maybe some other things. Some say it's not as decentralized. It's obviously been downtime. That Ethereum now has been chosen. First of all, is that true in your mind from everyone that you're talking to in the institutions? And then I actually want to talk a little bit about, your main competitors.
Sure. So I think that there is no debate and there is empirical data that shows high quality liquid assets, which is what I think is important. If you're talking about a global settlement layer, like I don't care much about meme coins or swords of a video game or, what I think that I'm interested in, and I think what Ethereum serves for is a global settlement layer to the economy of the world. And right now it's still very early days, but Ethereum has basically 90% market share as that settlement layer.
Okay.
And I think so there's no debate there.
Okay. Let's talk about the competition because it's very unique. And I'm curious how you feel about competition and if you think more is coming. Yeah. We've got Bitmine Immersion, which is the getting more famous every day, Tom Lee, who has been an analyst for a long time, was bullish on Ethereum for a long time. Saw him on CNBC, bullish on stocks, bullish on crypto, and then all of a sudden he's the chairman of Bitmine Immersion. They have, I think, about $5 billion of ETH, about 1.5%. I think he's going for 5%. That's been the one that's been talked about, and I guess that's liquid. There's SharpLink, which is Joe Lubin of ConsenSys in the past, who I think has about 3.3 billion of ETH. And then there's you. One of the big things about you, Andrew, is I think you put in about 650 million of your own supply of ETH, which gives you a ton of cred of the ETH machine. Then there's Zilla, and I think it kind of drops off from there. Have I got that about right? And how do you look at those competitors? Are they different? Do they help you ultimately?
Yeah. So great question. First and foremost, I have a ton of respect for Tom and Joe in what they're doing. And I think you did point out something right in the sense that I've put more skin in the game, materially more than anybody in all Treasury space. And that brings me to kind of a bit of a differentiation. Broadly speaking, Bitminer and SBET are reverse takeovers of shell companies.
Okay.
And what we've done is we've done a de novo entity. And I'll just speak kind of broadly speaking about this. So I wanted to contribute some of my own capital because I didn't want to recommend something to anybody else that I wouldn't do myself. And I thought that was important to me to basically lead by example and say, this is something that I am patient zero. I am a shareholder as well. And everyone was investing pari passu with me. And when I looked, broadly speaking, at the two paths, one, or let's call it three paths. One is to do an IPO. And I didn't think that made sense. It would take a year plus to, create an S1 and go through like the full capital markets process. So then there were kind of two paths. One was to do a reverse takeover, or the other was to do a SPAC. And I had a few conversations with some reverse takeover targets. And so basically, broadly speaking, anybody who wants to sell me their publicly traded business on the Nasdaq is doing that because their business is failing. And within a failing business, there are lots of contingent liabilities. I'll give you a few examples. One was a biotech company where the drug didn't make it through clinical trials and basically was going out of business. And due to how the SEC works, you can't have just a rapid removal of a CEO because there are what are called change of control provisions. So basically, I would have, if I went down the path of this particular reverse takeover, I would have had to pay a CEO who wanted $5 million a year to stay on the board. His company is bankrupt, basically. And the guy didn't know how to spell Ethereum. And I didn't want that ongoing liability. Okay. Another, there are Bitcoin mining firms that are, another example was one that was in a 10-year data center lease, and they were paying $10 million a year, where they were hosting all their data, their mining hardware. And now I don't need any of that because I'm an Ethereum staking facility that doesn't need the hardware, the electricity, or the real estate. But they're in year 4. They've got 6 more years of $10 million payments. I didn't want to incur those costs. Furthermore, there are companies that are now reserving part of the assets of the treasuries for lawsuits. That, if one of these companies, they have a 4-year statute of limitations, sure, maybe now they're going in the direction of having a digital asset treasury, but they can get sued for previous, the previous 4 years of whatever that operating business was. So I essentially didn't want pre-existing operating businesses, pre-existing cap tables, pre-existing liabilities, pre-existing potential lawsuits, because something, a company may not be sued if their market cap is less than $10 million, but if they have $1 billion, $3 billion of an asset, that becomes a honeypot now. And you have to kind of think through what are you inheriting? So basically, first and foremost, I would say I wanted something clean. And I wanted, so basically what we've done is we have a pure play de novo brand new entity that is anchored with Ether, that is merging with a special purpose acquisition company and creating this new operating business that doesn't have any of that pre-existing skeletons in our closet, if you will. And for me, with my assets, that was the only way I could get comfortable with this with this model. And to devil's advocate that, what I'm going through right now is what's called the S4 registration process. So an S1 is if you do an IPO, and S4 is if you're doing a merger.
Peter Thiel took $500,000 and turned it into $1 billion using the exact same techniques we're using inside the investment club. He met a CEO, his name was Zuckerberg. He pitched him the deal and he said, okay, I'll give you $500,000. Mark went public and sold the shares to people like you. Well, what happened to Peter? Well, he exited and got a 2,300x return. The wealthy invest in early stage companies, folks. The public markets are for suckers. It's a rigged game. By the way, this happens in crypto as well. It's called pre-sale tokens. This is Solana. Does anybody know this chain? They sold pre-sale tokens for 4 cents. And you can see the date on there, April 5th, 2018. Look at Solana today, folks. That thing's up over 1,000x. The media and Wall Street and all these hype people get you to buy the top. Meanwhile, they put their clients in at the bottom and they use you for liquidity to make their clients rich. You can play this same game. You just have to have the financial education and the deal flow. That's it.
And we're doing a merger between our LLC, the de novo LLC, where the anchor Ether is, and the special purpose acquisition company that doesn't have a pre-existing operating business. And, I would say our one differentiation there is that we're not, let's call it while we have stock that there is publicly tradable ETHM stock that people are able to acquire, we're not fully merged just yet. And basically there's about a 60-90 day window. And then at that point, we are able to start to use, let's call it, all of the traditional capital markets tools and to trade similar to these shell companies. And I think that to devil's advocate that, for example, in those 60 days, Tom Lee has been able to go out and acquire a gigantic amount of Ether. And I was not comfortable with the risks of the pre-existing liabilities that I just said for potentially the reward of being able to acquire that amount of Ether. We've been able to raise a considerable amount of capital, over $2.5 billion privately, because of the fact that when I talk to institutional investors and they go to their investment committee, they say, well, if we want pure play exposure to Ethereum, but we've got to deal with this pre-existing CEO and they may get sued. These guys are saying, we get laughed out of our investment committees rooms if we kind of try to propose some of these ways. So I think that time will tell. But with that said, we've tried to create an institutional vehicle. A lot of these shells, broadly speaking, have investment banks I've never heard of before, law firms I've never heard of before, and auditors that I've never heard of before. And we've come to market with Citi. Is the only one that has kind of a bulge bracket investment bank. This went to the top of the house. Jane Fraser signed off on this. They're not doing any other treasuries because they do understand kind of the nuance of having a pristine structure. KPMG is our auditor. Aside from MicroStrategy, we'll be the first treasury to go through a Big Four audit. Skadden, AmLaw 10 is our law firm, which is one of the largest, most accredited law firms in the world. And what I think is important here is that I believe that because we have this pristine entity, cleanest credit rating from a perspective of having a Big Four auditor, and none of those pre-existing liabilities, I believe that we'll benefit from the best priced and probably first to market convertible bond issuances and or preferred share issuances. So to understand that, basically these preferred shares or convertible bonds are credit or debt instruments. And basically the counterparty to that is buying paper, right? And when you're buying paper, you have to price in these types of risks. these opaque risks. Like, is there some skeleton in the closet that could cause the stock to go down 20%? That's separate from the net asset value of the underlying digital asset. I think that's important. And so
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.
Hey, I know investing in crypto is scary. It takes a real leap of faith because there are so many scams, rug pulls, and bad actors out there. It's a dangerous business, which is why 95% of people lose all their money. Well, that's why I created the London Real Investment Club, so you can access the hottest deals on the planet and use the crypto bull market to create the generational wealth that you deserve. Join my team of over 100 people from around the world that are making millions of dollars behind the scenes investing in blockchain, AI, Web3 games, DeFi, Bitcoin, and more. Don't miss out. Click the link below to book a call with one of my team now. But hurry, this bull market will end soon.
I know investing in crypto can be scary. That's why you gotta join the investment club. Pull the trigger. Let's do this.